Put $10,000 back into your TFSA too early, and the Canada Revenue Agency can hit you with $100 every single month until you fix it. Most Canadians treat their TFSA like a regular savings account. Take money out, put it back whenever cash flow improves. But that withdrawal doesn't restore your room until January 1st of the next year, and redepositing before then is an overcontribution. Here are the mistakes triggering those penalties. And the one at the end catches almost everyone. The core number here is 1% per month, charged on the highest excess amount in your account for every month it stays there. According to the CRA's TFSA guide, that works out to roughly a 12% annual penalty. I read the fine print so you don't have to. And unlike your RRSP, there is no $2,000 grace buffer. The penalty starts at the very first dollar of excess. The most common mistake is treating your TFSA like a checking account. Money in, money out, money back in, all in the same year. It feels completely safe because your withdrawal was tax-free, so surely putting it back is too. But the CRA doesn't add that withdrawn amount back to your contribution room until January 1st of the following year. Say you fully used your room, withdraw $5,000 in June, and redeposit it in July. Per the CRA's TFSA guide, that's a $5,000 excess and the tax is 1% per month, $50 monthly, or $300 if it sits from July to December. The fix is simple. Only redeposit in the same year if your CRA My Account shows unused room. Otherwise, wait until January 1st. Mistake 2 is assuming the TFSA has a grace cushion like your RRSP does. With an RRSP, you get a $2,000 buffer before penalties kick in, so people assume there's a little wiggle room in a TFSA too. There isn't, and that assumption is exactly what turns a small mistake into a monthly charge. Here's the trap. As IG Wealth Management and the CRA both confirm, the TFSA has no $2,000 grace room at all. The penalty applies from the first dollar of excess, not after a cushion. So the fix is to treat your available room as an absolute ceiling. Never contribute a single cent beyond the number CRA My Account displays for you. Mistake 3 is the exact scenario that caught Sarah, a 32-year-old designer in Toronto. She'd maxed her 2026 room, withdrew $8,000 in July for an emergency, then redeposited that $8,000 in September once her cash flow recovered. She genuinely believed the withdrawal had freed up room. It hadn't. That room doesn't return until January 1st, 2027. Because Sarah had no room left, the CRA's TFSA guide treats the full $8,000 as excess. That's 1% or $80 per month. If she catches it and withdraws in December, that's September through December, 4 months, $320 in penalty tax for simply moving money too early. The fix. Note the year of every withdrawal and assume it only becomes room on January 1st of the following year. Mistake 4 is thinking the clock resets at year end. Sarah assumed the problem would just sort itself out in January. But the 1% monthly tax keeps applying every single month the excess remains. It doesn't magically expire when the calendar flips. If you ignore the CRA notice, the meter just keeps running. If Sarah ignores it until a CRA letter arrives in June 2027, the math per the CRA compounds. 4 months in 2026 at $80 is $320, plus 6 months in 2027 is another $480. $800 total on one redeposit. If she'd simply waited until January 1st to recontribute, her penalty would have been $0. The fix is to withdraw the excess the instant you suspect it, which stops all future months' tax cold. Before I get to the last one, which is the most counterintuitive piece of this, here's mistake 5. Even people who catch the overcontribution and withdraw it forget there's a separate filing obligation. You still have to file a special TFSA return and actually pay the 1% tax you owe. Skipping that paperwork adds compliance risk on top of the penalty itself. Per the CRA, the special TFSA excess return and the tax owed are both due by June 30th of the year after the overcontribution. Missing that deadline just stacks compliance headaches on top of the money you already owe. The fix is straightforward. File the CRA's excess contribution return and pay the 1% tax by June 30th. If this is useful, subscribe. The next breakdown is already coming. And here's the one almost every Canadian makes. Never actually checking your exact room before you redeposit. This is the least obvious and the most expensive. If Sarah leaves her $8,000 excess for 18 months, that's $1,440 in CRA penalties. and modeling that lost money at 5% over 30 years adds roughly $6,200 in foregone tax-free growth. A total effective hit near $7,600 from one careless redeposit. The fix costs nothing. Log into CRA My Account and confirm your available room before you contribute a single dollar. So before you ever put a TFSA withdrawal back, open CRA My Account, confirm your exact room, and if it shows 0, wait until January 1. Next, I'm covering the RRSP withdrawal traps that quietly shrink your retirement. If you want to catch that, subscribe so you don't miss it.